Hey everyone! Today we're going to do something really practical. We're going to build an investor's toolkit from the ground up. This is for anybody who's ever looked at their 401k or their investment account and just felt a little in the dark, like you're just hoping for the best. Well, we're going to change that. We're going to replace that hope with some real knowledge and control. Let's get into it.
So here's the game plan. First, we're going to talk about moving past this idea of just crossing our fingers. Then we'll start building. We're going to get a tool for checking a company's health, another one for figuring out if a stock's price is fair, and then, and this is a big one, we'll uncover the hidden fees that can eat away at your money. And finally, we'll wrap it all up with the kind of mindset that really successful investors use.
All right, section 1. Let's just be real for a second. For a lot of us, investing can feel like putting money into a black box, right? You contribute to your mutual fund, maybe check the balance once in a while, and you just kind of hope it goes up.
And this quote just nails it, doesn't it? It perfectly captures that passive feeling. When you're in some massive fund with 1,000 different stocks, you're not the pilot. You're just a passenger. You have no control over what's bought or sold. You're just sitting there hoping the person in charge is making good decisions for you. And that's really the big question here. What if just hoping for the best isn't a real strategy? Because true financial confidence, it doesn't come from wishful thinking. It comes from actually knowing what's going on. It comes from having the right tools to understand what you own, why you own it, and what it's costing you. So let's start building that toolkit right now. Okay, let's grab our very first tool. I want you to think of this one as a financial X-ray. It's a way to look right through all the noise of the daily stock market news and see the actual bones of a company, to see if it's healthy and strong on the inside. And what's so cool about this is how simple it is at its core. I don't care if we're talking about a huge tech company or the local pizza place down the street. Every single business on planet Earth is built out of these 4 things: money coming in, money going out, stuff they own, and stuff they owe. That's it. Everything else is just details. So, using those 4 building blocks, we can create some incredibly useful little gadgets. Our first one is the debt-to-equity ratio. It sounds technical, but all it does is answer one simple, critical question. Is this company running on its own money, or is it propped up by a mountain of debt? You see, a company that owes everybody money is fragile. One little problem, and the whole thing could collapse. This ratio is our first quick check for financial risk. And if that still sounds complicated, this quote makes it crystal clear. Just think about your own life. Add up your car loan, your credit card bills, any money you owe. Now compare that to your net worth, what you own free and clear. That's your personal debt-to-equity ratio. It's the exact same idea for a multi-billion-dollar corporation. So what's a good number to look for? Well, we can take a tip from one of the best investors ever, Warren Buffett. He likes to see companies with a ratio below 0.5. So what does that actually mean? It means the company has more than double the amount of its own money, its equity, than it does debt. That's a huge sign of stability. It tells you this is a business that can survive a tough year without going broke. Okay, tool number 1 is in the kit. We know how to see if a company is financially strong. Now for tool number 2, which answers the next big question. Okay, it's a good company, but am I paying a fair price? So many people get hung up on a stock's price, but they forget to ask about the value they're getting for that price. This tool connects those 2 things. And first, a quick public service announcement. Anytime you hear that word ratio in the financial world, I want you to just swap it out in your head for the word relationship. Seriously, that's all these things are. A ratio isn't scary math. It's just a simple way to describe the relationship between 2 numbers. And that brings us to the famous PE ratio. This is probably the most common relationship metric out there. It simply compares the price of one share of a stock to how much profit or earnings that one share is responsible for. It's a fantastic shorthand for figuring out if a stock seems cheap or expensive compared to its actual business performance. And look how easy the math is. You just find the stock price, which is everywhere. You find the earnings per share, which is also on any finance website. Then you just divide the price by the earnings. That's it. P divided by E. That single number tells you a whole story. Now this right here is the magic trick. This is the phrase that makes the PE ratio something you can actually use. So if a stock has a PE of, say, 15, you just say to yourself, for every $15 I spend buying this stock, I can expect the company to make $1 in profit this year. It instantly turns an abstract number into a real-world concept. So let's just look at this visually. If a stock has a PE of 10, you're paying $10 for your claim on $1 of that company's profit. Not bad. But if the PE is 20, now you've got to pay $20 for that same $1 of profit. And if the PE is 100, well, you get the idea. A lower PE means you're getting more bang for your buck in terms of current profits. A higher one means you're paying a lot more, usually because everyone is expecting huge growth down the road. All right, we know how to check a company's health, and we know how to gauge its price. But there is a third, sneaky element we have to talk about. This is the thing that can be silently draining your account without you even realizing it. So it's time to pull out our third tool, the magnifying glass. We're going to look at fees.
So here's the deal with most mutual funds. You're paying a professional, right? You give them a fee, and the whole idea, the entire promise, is that their skill and expertise will earn you more money than you'd make by just passively tracking the market. It sounds great on paper, but is it actually happening?
Okay, now this chart shows the cold, hard facts, and it is pretty shocking. This data compares thousands of professional fund managers against the plain old S&P 500 index. And look at that column on the right. Over pretty much any time period you look at, 1 year, 3 years, 5 years, about half, or usually more than half, of all these highly paid professionals failed to beat the market. They charged a fee for their services, often called an expense ratio, and then delivered results that were worse than if you just bought a simple, low-cost index fund. And the amount of money we're talking about here is just staggering. The source material for this explainer pointed out one very famous fund that collected somewhere between $4 and $5 billion in fees from its investors, all while underperforming the market. That money comes right out of your returns. And it's all because of that little line item called the expense ratio. You might see a 1% fee and think, oh, that's tiny. But on a $100,000 portfolio, that's $1,000 every year. Over 30 years, that tiny fee can literally eat up hundreds of thousands of dollars of your potential gains. It is a silent portfolio killer. And this quote just hits the nail on the head. When a fund is charging you a high expense ratio but is basically just tracking the market anyway, or doing worse, what are you paying for? You're paying billions of dollars, collectively, for a promise of market-beating performance that, for the majority of funds, just isn't being delivered. It's one of the biggest wealth transfers happening in plain sight. So, now we've got our tools. We have the financial X-ray, we have the smart price tag, and we have the magnifying glass to spot those fees. But the last piece of the puzzle isn't a tool, it's a mindset. It's about how you approach the entire game of investing in the first place. The classic book Rich Dad, Poor Dad lays this out perfectly. The mindset on the left is all about earning money from a job. It's focused on your paycheck, your next raise. It's trading your time for money. The mindset on the right is totally different. It's focused on owning things, assets, businesses, stocks that make money for you, even while you sleep. It's a huge shift from relying on your boss to relying on your investments. And this is where all of our tools come together. A long-term investor thinks about buying a piece of a business, not just a ticker symbol that blinks on a screen. They use their X-ray to find great companies with long-term potential. They hold on to those companies for years to let them grow and to avoid paying a lot in taxes. And, this is the most important part, when the market freaks out and everything goes down, they don't panic. They see it as a sale, a chance to buy more of those great businesses at a discount. So, there you have it. Your toolkit is complete. You have the X-ray to check for quality, the smart price tag to avoid overpaying, and the magnifying glass to protect yourself from killer fees. And you have the mindset of an owner. The knowledge is officially yours now. So the only question that's left is the one you see on the screen. Now that you have the tools, how are you going to use them to build your future?